Hey everybody, Kevin here with another episode for you of the Real Estate Without Renters podcast. Thank you as always for listening to the show. And please, if you like the show, give me a nice rating on there. Subscribe to the show. I'd appreciate that. And please, if you're a part of any kind of meetup group, a real estate investment club, any kind of investment club, please let people know about the show. And that way I can expand it, get you more episodes, and bring on great guests like I have today for you as well. We're going to talk some things about the industry, about the big companies, how they do the trading, how the inventory funnels down to individual investors like you and I. And there's a big process involved with that. And there are people in the middle that take these big chunks of notes and they put them down into bite-sized pieces for us. And that's an important part of our process. And that's what enables smaller investors to get involved in these things for, $20,000, $30,000 on a low end and upwards from there. So it's going to be a great conversation with our guest. And I'll introduce you to him in just a minute. I've got Dwayne Gibbs here with me as well. Dwayne has been traveling with me on trainings. I was saying the other night, we did an event together. I said he's been to more trainings of mine than anybody has, because we traveled together about 10 years teaching people. And so it's always great to have him on. Dwayne, how you doing?
Good. How are you?
I'm doing good. Thanks for being on. And I want to introduce your guest. I've known Bob Repass for going back, I guess, 15 years, maybe before that. But Bob's history in the industry, starts at a very high level with big companies that were instrumental in really almost the creation of this industry, the way it's been structured today. And that went on to manage funds, and which he's still doing today. And recently started with Revolve Capital Group, which, look at that, Bob.
Oh,
there you go.
See? I got the goods from
that Did he sign that for you?
Yeah.
Is that an autograph?
I couldn't, you guys weren't paying me to do this, so I'm not going to wear the cap during the podcast, but I just let you know, I've got some gear, I've got some shirts,
I'm glad you got the swag. I always
did get
represent
the swag. So yeah, Chaz sent that to me, so I appreciate that. But welcome, Bob. How you doing?
I'm doing good, Kevin. It's good to see you, and good to see you, Dwayne. And I'm excited about the podcast. I like sitting around and just kind of chatting about the industry, and we can look back at the history, and then we can look forward at the future. So I'm ready to roll.
Yeah, it's crazy how it repeats itself in many ways, sometimes in a different version, but there's not many people that go back, that far. I started back just as an individual investor. I was doing a lot of brokering of notes, and you were already probably, when you first started, I think you were directly with Bayview, right?
Well, I first started back in 1990 with Metropolitan Mortgage and Securities.
Oh, you were with Met. Okay.
Yeah, so I started them way back in the day. And, it's funny, you talk about history and how things go, keep going around. It's like when I started working back in 1990, Kevin, I was running an operation on the East Coast for Metropolitan. They were based out of Spokane, Washington, and wanted to move out east. So I opened up an office in Raleigh, North Carolina. And my main transaction manager back in Spokane was Tracy Rui.
Yeah.
So Tracy Z and I go way back. And then also Melissa Bowling and from Allied. They worked at Metropolitan, and Fred Rui ended up working at Metropolitan. So, it's that old, Met group that's still floating around. And I still get deals from a lot of folks that used to work there, and still cross paths. So
Met was that was our go-to. So when Joe and I had a company, we brokered predominantly through Met, so Metropolitan is what we're referring to. Everybody. It was a company out of Spokane, Washington. They're no longer around since the founder passed away. So it's been years since Met's been in business, but that's where we met all of those folks that you were mentioning as well. So what I'm referring to everybody, when I first started in the business, didn't have the capital to invest notes myself, but I found out that if you could study and learn how to identify a deal and put that deal together in some sort of presentation, whether that's just a verbal communication or a PowerPoint or, a 3-ring binder, back in those days, whatever it was, and present that to companies that are readily able and had the financial capabilities to buy, that's a good way to make money. So Metropolitan was one of those companies that not only bought real estate notes, but all kinds of different cash flows on there. So Met was the biggest player, I think, at that point.
Yeah, and I've been fortunate enough. Over time, I've worked at 3 of the largest institutional investors. And we can talk about how that pivoted after 08, 09. But I
Yeah.
moved to Texas in 1997, went to work for the Associates. And at that time, the
Okay.
Associates was one of the biggest companies out there. And
Mm-hmm.
then in 2000, Bayview wanted to get in the seller finance discounted space to kind of supplement their, scratch and dent, subprime, and commercial originations. So I opened up an operation here in Texas for Bayview and worked for them for 12 years.
Yeah.
And then, in 90, I guess about 2008, when everything kind of went down, institutional investors kind of tightened up, and that's where the private equity and private funds came in, and people started creating the capital funds that you referred to at the top.
Right.
And,
Before you jump in, sorry to interrupt. Before you jump into there, Dwayne, when did you get involved then in those
So I,
earlier days? Did you know Matt and all them, or you came in probably a little later?
yeah, no, I started in the training industry back in 1990. So 1990 all the way up to well, almost 29 years in the business.
Whoop, there goes Dwayne.
Of
Oh,
just
you froze up
putting
there.
in,
Okay.
knowing about Met, but it was all on never in that space to where I
Yeah.
knew Bob until about 15 years ago.
Yeah.
We kind of ran in that space, a little bit
Same
different
circles, but yeah, a little
situation for myself.
great. And
Yeah,
just to paint a
yeah.
picture
I think
for
we all come together at some point.
yeah.
I said I think we all come together at some
Yeah,
point.
yeah, for sure. To paint a picture for everybody listening or watching the video, that's back when, before we get to 2008, because that really completely changed our industry. So before we cross over that bridge, pre that period of time, our industry was truly a niche. And 2008 took it out of that niche and made it into really its own asset class that's recognized, nationally by investors. But before that, truly a niche. A lot of the notes that we were buying back then, everybody, was seller finance notes. And they were generated during the Carter administration years when interest rates at banks were 18%. Everybody's today's like going nuts at 7% and everything. It's short-term memories. People have been in and around this industry for a while. Yeah. Hey, 18% back in the Carter administration. Remember when we were waiting in gas lines and even numbers and odd numbers to get gas all those days. And people were really in a position where to sell their homes, they had to offer financing because people were not willing to sign a 15, 30-year mortgage at 18%. So the homeowners would say, hey, look, you don't have to. I'll finance it for you at 9%. And the niche grew out of that really, where we said, well, some people don't want, they'd rather have a lump sum. They just couldn't do it. They had to take a note back. So the methodology really became, well, some of those folks, certainly a good majority, I would think of those folks would rather have cash now, and how can we give them that alternative? And the answer is, well, we buy the note from them. And then it became, well, mathematically, how do we do that? We can't pay them full face value for the note. We have to buy it at a discount. So the industry, known as a discount mortgage industry at the time, the paper business. So it's evolved a little bit through that. But bringing you up to current times, I'll hand it back over to you, Bob, is when 2008 happened, everything changed. Technology was changing. More importantly, legislation was changing, and the way these notes were handled completely changed. So pick us up there, Bob, when the market switched.
Yeah, so in 2008, I was working at Bayview, and we were buying probably over $100 million of seller finance and discount mortgages a year, and mostly from brokers, like you talked about, people finding notes and helping somebody turn that into cash. And when I had to make the call saying that we were no longer going to be buying notes, there's a lot of people hurt on the other end of the call because they were relying on institutional investors like Bayview, for their takeout money.
Sure.
And so that was a crunch time for a lot. And at Bayview, we shifted and really became more of a loan servicing company.
Mm-hmm.
Because to your point about regulations, that's when loss mitigation really came in, as far as the government stepping in with the HAMP mods and various programs to help borrowers. So we completely shifted from an acquisition standpoint at Bayview at that point in time to loan servicing, not only for our own portfolio, but also for others. And Bayview to this day continues to run the servicing, and they're back obviously in the acquisition spot, in today's market. But that was a big change, not only for us, but also for the individual brokers and sellers out there looking to how am I going to get cash for my note
Right.
if the institutions aren't buying. And that's what shifted to the private investor scenario that we have a lot today. Some people are just selling them to individuals, and some are selling them to capital funds, which is made up of, private investors pooling all the money together into a fund. I like how you mentioned earlier, then it became an asset class. Now everybody from Wall Street on down knows about distressed debt, discounted mortgage. It is an asset class, and you can invest in it, individually or through various funds.
Yeah. I point out to people in a lot of my presentations, there's Robert Kiyosaki. And I tell people, look, whether you subscribe or agree with him on what he talks about, wealth and all that sort of stuff, put that aside. But when you have somebody who is recognized and bestsellers and everything else, where his books, his first initial books never mentioned notes, and all of a sudden that changed, and he lists, stocks, stock market, real estate, notes, and then intellectual property. He goes, that's the way to do it. And his definition of wealth, which Dwayne, I shared on the screen with everybody on our presentation last night. He talks about to have true financial freedom, you need to be in a business or an investor that's making cash flow on a passive basis, preferably monthly. And it's like, that's pretty much the definition of what we do. So you got into then the private equity, because that's where the money went, because the bigger buyers, there's a lot fewer than there was, a big change in the industry. But the industry inventory actually grew, at that same time because of the financial crash. And it mostly grew in the form of non-performing loans. Today, we're seeing more performing loans, probably 70-30, at least at my level. We'll talk about what you see. But back then, there was a lot more on the non-performing side because of the banking crash, the financial crash, then the Dodd-Frank Act came in there. So I think that's what elevated it. But at that point in time, the bigger players were kind of out of the picture. So that was the surgence of the private equity firms, and gosh, a lot of people that we've trained are doing those type of funds. A lot of people that you Bob have worked with as well,
Right,
doing those funds. So you ran those, and just from a management standpoint, give us a little insight on how that works and how you look at notes. Because I tell people all the time, when you have these bigger companies or mid-range companies that have 20 million, $50 million, they don't look at and really have the luxury, as I put it, to look at every individual note that they buy. They have to buy on averages and weighted means and things like that. So that's why it's not surprising sometimes where we look at some notes that some of those private equity firms are selling, and you go, hey, you're missing this, or that's not quite there. It's like, don't expect them to be perfect, but that's our job as an individual investor. So give me your thoughts on that whole area.
yeah, I mean, obviously you wouldn't believe, or you probably can understand how sophisticated some of this financial modeling is when you're going and you can be looking at hundreds or even thousands of assets, and you're running them through your model, and you're trying to figure out, how you're going to price, and you price per se loan level, but to your point, you don't really know each individual loan. You are doing it based on, a bucket here, and, you kind of look at it that way. And that gives people, as the loans flow from, Fannie or some larger private equity, some slip through the cracks and fit better for investors like us. And then some will even slip through our cracks and fit better for the individual investor, right? Whether that's the size of the loan, or whether it's the location of the loan, or the delinquent status of the loan, something fits for different people.
Sure. And that's where, on my end of this with the educational side, it's so important to tell people you can't just say, oh, well, this comes from a big successful fund that does. It doesn't mean that particular note, out of all the ones that they do, is perfect. So we have to find out the imperfections in these notes, and then we have to adjust our risk, which usually adjust the price or things like that to make it work on the individual level. And some people, they get into this business and their goal really is to get to that level as a fund. And I often caution people, I say, careful what you wish for sometimes, because I think where people fail sometimes is they try to do a private equity fund with not enough money. Agree?
I agree. It's not as sexy as it sounds when you go around saying you're a fund manager. And it does take, there is a certain tipping point where if you don't have a certain amount of capital, in order to make it work, it's not worth going through the setup of the fund. It's not cheap to set up a fund to start with.
Right.
I mean, if you're going to do a PPM and you're going to raise money, I mean, you're going to be sinking $20,000-$30,000 just in getting the structure put together. So it's not cheap. And, you know, there's a lot of moving pieces, right? You're going to own hundreds of assets, and you as fund manager need to know what's going on with each one of those. So at Revolve Capital, we look at it like we look at institutional paper, but we also look at seller finance paper. And we basically put it into three buckets, right? We look at assets that we want to buy and hold, and we'll work out through resolution. We'll look at ones that we want to buy and hold and work out through foreclosure. And then we'll look at ones that we want to buy and then retrade. Right. So we try to do that on the due diligence level, like identify based on where they are in the foreclosure process or where they are in the performing loan status, as far as how much seasoning they have, how much equity they have, which bucket we're going to put in. And we'll take a performing loan, keep it for 6 or 12 months, and then sell it, so we get cash flow for a while. So we're looking at all those different angles. And we'll buy small balance stuff, but we got 2 loans right now that are over $1 million on property. So we don't play in that space a lot, but if it's part of a pool, I would say our average deal is probably in the 250, 225 range UPV.
Right. And everybody, just again, as a reminder, I'm talking to Bob Repass, and he is now managing the funds, and correct me if I'm wrong on that, over at Revolve Capital. And if people want more information about Revolve Capital, is it RevCap Group still, or did you change your website? What's the website?
The website is revolvecapital.com.
Revolvecapital.com.
And if
and
you're
what do investors get there at RevCap? They can invest in a fund, or they can invest in individual notes. How are things working over there?
Yep, the answer to that is yes and yes. If you go to the website, there is information on becoming a passive investor in our fund. It's got a video, it's got the PPM, it's got all the details on that. And then you can either go on to revolvecapital.com, or you can email trade desk at revolvecapital.com and get signed up with us in order to receive the offerings that we put out periodically. We did one about a week ago, and we'll be doing another one at the end of March. And you can just email trade desk, get on the list. You'll fill out a short questionnaire, and then you'll be receiving offerings as they come out.
Okay, so just for clarification, if somebody wanted to invest in Revolve Capital's fund, they would have to be accredited?
Yes.
Okay. If they're just buying an individual note or a small, couple of notes from RevCap that you guys are selling, then you don't have to be accredited or anything.
Right.
Right.
We just ask for a little bit of background information as far as, experience you may have in the note business, and what area you're looking to invest in. You want performing, reperforming, non-performing, just kind of a investor profile. So, you want to buy performing loans, and all I do is send you tapes of non-performing loans. That's not a very good strategy for either one of us. So we just kind of, sometimes we send out a mixed bag, but sometimes we'll say, all right, who do we have looking for performing loans? And we'll send out some performing loans that way.
Yeah. I usually so my audience is mostly individual investors, and I always tell them, all of the above. Don't single yourself out of performing and non-performing, because at some point in time, people switch from one side to the other. And in my mind, they're all, it all comes down to valuation models and the ratios that we look at. Is it a good deal or not? Whether it's performing or non-performing, usually has to do with price and time frame.
Kevin, as well as I do, when people say, "Oh, I only want to invest in performing loans," well, as much due diligence or analysis or modeling you may do, some people still die. Some people still get divorced. Some people still lose their job. And that performing loan you thought you had all of a sudden now becomes non-performing. And if you're not familiar with what to do with a non-performing loan, you're really got 2 choices: take a big loss or sell it and go let somebody that knows.
And try to minimize your loss. It's going to be a loss, though. Yeah. And I so agree, because that's why I teach people the business, not, you just want to focus on that. You got to know both for that reason. Because again, non-performing notes, the goal most of the time is to get it reperforming again, and then
absolutely
there,
and
if you're selling a property and creating paper, well, create a good quality note. Don't create a crap note and get a crap price for it. You want to create a good quality note. So if you do decide to resell it, you're not taking a big hit. Yeah.
Yeah, and that's one thing, you know, when I was saying sometimes we buy it and take it through to foreclosure. If we take back an REO, right, depending on where it is and what the value of it is, instead of just always listing it with a realtor and selling it or selling it to a wholesale investor, we'll look at seller financing that to a deserving homeowner. You know, because like you said, then you create a performing note and you're right back there. And then down the road, I can sell that performing note. So you have to know that whole cycle, you know, as far as buying a loan, working it out if it turns non-performing, and what to do with it when it becomes REO.
Right. So let me slow down the motion picture a little bit here and say, okay, so I'm an investor. I'm listening to this podcast. I'm going to go to revolvecapital.com and I want to look at the notes that you have for sale. So I'm going to register. I'm going to fill out a small profile. Do I have to pay to get that list?
No. Once you
Okay.
sign up with us, you're on the distribution list to receive our offerings.
Okay. So then I wait for an email. I don't have to log into the site and keep checking back and saying, are notes available yet? Do you do a more of a push out to everybody?
Yeah, at this time we're doing a push out. We're also do continuous updates, like, hey, there'll be a portfolio coming out on March 22nd or whatever. It would kind of give people a couple weeks heads up that something's coming down, you know, and just kind of keep the communication. We don't bombard people with a bunch of emails, but we try to at least say, hey, this is what's going on this month at Revolve Capital. We got this happening. We're going to go to the IMN conference at the beginning of March. We're going to send out a loan offering the third week of March. You know, we just kind of tee up the month for everybody.
Gotcha.
And if you want to get those, go to trade desk at revolvecapital.com and sign up, and you'll get on the distribution list.
Award winner Kevin Shortell.